All right, we are going to try to finish up chapter 14 today. The next thing on our chapter 14 agenda is how we deal with bonds that have equity characteristics. So we're moving into a hybrid kind of territory. These are bonds that aren't just debt. Um, they also have interest and principal repayment. So the bondholders get potential ownership benefits. And there are two major ways that this happens, and that is stock warrants and convertible bonds. Oh, what is my computer doing? That's weird. Okay. So stock warrants are agreements that give bondholders the option to purchase a specified number of shares at a predetermined price within a certain time period. Think of them as kind of like a bonus feature. The bondholder keeps the bond, but also gets the right to buy stock. So that gives the investor a dual set of rights, the right to collect interest and principal, and then the right to acquire stock and benefit from dividends. We have some formulas up there to help us figure out the amount assigned to bonds, the amount assigned to warrants, and those two together equal our issue price. So an example. January 1st, year one, Grant Company sold $800,000 of 12% bonds at 101 or $808,000. Each $1,000 bond carried 10 warrants, and each warrant allows the holder to acquire one share of $5 par common stock for $25 per share. After issuance, the bonds are quoted at 99 X rights, so that means without the rights attached, and the warrants are quoted at $3 each. So, would you figure out our issuance price? Ooh, my notes are all weird today. My notes are very weird today. What's going on? So the key accounting rule here, if warrants are detachable, GAAP requires us to allocate the proceeds between the bonds, the debt part, and the warrants, the equity part. And we cannot treat the entire amount as debt because part of what investors are paying is equity value. So we allocate the proceeds based on relative fair values. And that's what our formula down here is doing. We're comparing market value of bonds without warrants and market value of warrants. And then we're assigning the issuance price proportionally. So debt's going to get a share, equity is going to get a share. And the two amounts have to add up to the total cash received. The grant sells for $800,000 at 101, which again is 101%, so 808,000. And each bond has 10 warrants attached. Bonds trade at 99 without the warrants. And warrants trade at $3 each. So the market value of the bonds alone, $990. So our $1,000 bond at 99, $990 times 800 equals 792,000. Market value of the warrants, 3 times 800 times 10 gives us 24,000. Total combined value, 816,000. We're going to allocate all of this proportionally. The amount that gets assigned to the bond, $784,235.29. So our 792 over 792 plus 24 times our 808. And then the amount assigned to the warrants, 23,765. Sorry, my second screen is doing really weird things. So what happens next? The bonds get recorded at a discount because the amount assigned to bonds is less than our face value. The warrants are recorded in equity, typically as common stock warrants, with additional paid in capital. We're going to debit cash for $808,000. We're going to debit discount on bonds payable for $15,764.71. So up to that. sorry, brain work, up to the rest of our total amount there. Credit bonds payable for 800,000. We're going to credit common stock warrants. So debit portion, we have an equity portion, we have clean separation there. Let's go to an example. This always works better when we have an example. We're doing number 11 over here. And we're just trying to figure out the amount attached to to our bonds and the value assigned to our warrants. Maybe. Come on. My computer is being very slow today, guys. I think it's the weather. I think it's decided it's rainy and it shouldn't have to do anything. Okay. The question we have up there is real tiny. Let's make that bigger. There we go. Okay, on January 1st, year one, Langdon & Co. issues bonds with a face value of 50,000 for 51,000. Each $1,000 bond carries 10 warrants, and each warrant allows the holder to acquire one share of $1 par common stock for $40 per share. Immediately after the issuance, the bonds are quoted at 99x rights, and the warrants are quoted at $5 each. Calculate the value to be assigned to the bonds and to the warrants. Round your answers to 2 decimal places. So first thing we need to do, we're going to determine the total proceeds. We're going to get our handy dandy spreadsheet and we're going to make a new section. And we're going to call this section, what's the problem call this? Bonds with, we're going to call it detachable warrants. That looks good. All right. I'm going to make this super big. We're going to get some info. So first, we need the issue price of our bonds. We issued the bonds for 51,000. I'm just gonna like put my foot up. Okay. So for our issuance price, we 51,000. The 51,000 is the total amount that has to be allocated between our bonds and our warrants. The next thing we need to do, determine our market value of the bonds without the warrants. So the bonds are quoted at 99x rights, which means 99% of the face value. We have our issuance price. Let's get our face value. I spelled value wrong. There we go. Our face value is $50,000. Okay. Quoted 99 X rights. So that means our market value without warrants is going to equal our 50,000 times, and to make this just easier, we're going to turn this into a percentage right there. And I'll put our formula text. Or that over here. Okay. So that's the market value of our bonds without the warrants. The next thing we have to do is determine the market value of the warrants. So each $1,000 bond has 10 warrants. So we need to find the total number of bonds. So Try and think of the best way to put this in our spreadsheet without it being wonky. Or make a little like word math. Each $1,000 of bonds has 10 warrants. That way we could change those without having to rewrite the whole thing. So our total warrants is going to equal our face value divided by 1,000 times 10. Our face value divided by the number of bonds times the warrants for each bond. So it's not $500, it would just be 500. We have 500 warrants. Let's get a warrant quote. Our warrants are quoted at $5. So the market value of warrants equals our 500 warrants times $5 each, $2,500. So we've got the total market value of our warrants. We have the market value of our bonds without the warrants. So now we need to determine the total market value of both securities. I did something weird in my notes. Okay, there we go. Move this up here. Total market value of both equals the market value without warrants plus the market value of the warrants. The total market value of both is $52,000. Now, we only have $51,000 of proceeds that we can allocate, and we need to do that proportionally. So, we need to figure out the amount assigned to bonds and the amount assigned to warrants. We want to take our 49,500. We want to divide that by the total market value of both, and that's going to give us something like 0.951923. It's going to give us a ratio. But we're going to multiply that ratio by the issue price. So what percentage of the market value is without warrants or is bonds times our issue price? And I will put, again, all of that over here with our formula text. And we want to do the same exact thing to our warrants. The market value of our warrants, probably need some parentheses, market value of our warrants divided by the total market value of both, and what's in those parentheses would give us a ratio times or percent our issue price. Figure out the market values, add them together, proportion it all out to the issue price. So our answers over here, 48,548.08, 2451.92. And if we want to make sure this is right, a quick check. We can add this and this together, and it should equal, oh, what is weird? Should equal issue price. Or issue, what is it? Yeah, issue price. If it doesn't, we're wrong. If it's a little bit off, it might just be a rounding error, but ours equals perfectly. So that is our answer for over here. Value assigned to bonds, 48,548.08. To warrants, 2451.92. Now we have our bonds with detachable warrants done. The other equity type thing that we can talk about here is convertible bonds. Convertible bonds are bonds that can be converted into common stock. So the investor is going to start as a creditor and eventually they're going to become a shareholder. At conversion, the bondholder exchanges all of its bonds for a set number of shares. So there's no cash paid and the liability disappears and equity then increases. There are three primary reasons we do convertible bonds. Company might want equity later, but not necessarily today. Convertible bonds allow debt now and possible equity later. Conversion features make bonds more attractive to investors because you become a shareholder later. And because they're more attractive, companies can usually issue them at lower interest rates. And then investors get downside protection and bondholders get upside potential if the stock price rises. So they start as debt, converted, that debt becomes equity. They sit right in between liability and ownership. That's what makes them so powerful. FASB does not define a substantial premium percentage for them. However, in practice, auditors suggest that a premium greater than 10% would be substantial. So let's talk about how we record a convertible bond and when they are first issued. There are technically two possible approaches. So one option would be to split the proceeds. So we would allocate part to debt, part to equity for the conversion feature, kind of like what we just did. So the other option is to treat the entire issue as debt. Under current GAAP, in most cases, we treat the entire issue solely as debt. We record the convertible bonds in the same way we record straight debt. So that means debit cash, credit bonds payable. Record any discount or premium. We're not going to separately assign value to the conversion features when we issue them. So let's talk about what happens when the bonds are actually converted, or the moment of conversion. Two possible approaches. There is the book value method. This is the primary method that gets used. Under the book value method, we remove the bonds at their carrying value. I'm going to shut my phone, turn my phone on silent. I don't know why I'm popular today. Oh, it's because my kid's at home sick. So his dad is texting me like crazy. Anyway, we're going to remove the bonds from at their carrying value. We're going to issue common stock and additional paid-in capital equal to that book value. So no gain or loss, simply reclassifying from liability to equity, and nothing hits the income statement. With the market value method, our alternative approach here, we record the shares issued at their fair market value on the date of conversion. If the value exceeds the carrying value of the bonds, a loss is recorded, and that loss would then go into income from continuing operations. It's not a lot of situations where market value method is used. So an example, Shannon Corporation has outstanding convertible bonds, face value 10,000. Interest was just paid on these bonds, which have a book value of 10,500. Each $1,000 bond is convertible into 40 shares of common stock. Par value is $20 per share, and market value is $26.50 per share. All of the bonds are converted into common stock. So using the book value method, we ignore market price. We remove the bonds at carrying value. So we debit bonds payable for 10,000. Premium on bonds payable is 500. Total carrying value removed that we've removed is 10,500. And we calculate shares issued. If each $1,000 bond gives 40 shares, we have 10 bonds, and 40 times 10 is 400 shares. The common stock there. Okay. The common stock there would be 400 shares times $20 a share, so 8,000. And the remainder goes to additional paid in capital from bond conversion, 2,500. No gain, no loss, just reclassification. The market value method. First, we're going to calculate the value of the shares issued. So 400 shares times $26.50 equals $10,600. And under this method, we're going to record equity at 10,600, but we're only removing the bonds with a carrying value of 10,500. So the difference creates a loss on conversion of $100. So we debit bonds payable for 10,000, premium on bonds payable for 500, loss on conversion for 100, and then common stock for 8,000 and additional paid in capital for 2,600. And now we have an income statement impact because we have that loss on conversion. So book value method, ignore the market value, no gain and no loss. Market value method, use fair value of the stock and recognize loss. But in practice, we're almost always going to use the book value method. So let's do numbers 9 and 10 on our Cengage. Sorry, these are like all weirdly out of order. Okay. January 1st, year one, Branson Corporation issued $500,000 of bonds, of convertible bonds at par value. The bonds were issued with a stated interest rate of 3%. Each $1,000 bond is convertible into 20 shares, corporation's $1 par value common stock. Branson may also elect to settle bonds with a cash payment in lieu of issuing stock. Similar bonds without the conversion feature would have sold for $455,000. That's a lot of money. That would be nice. So let's look at, I went too far on my notes. Let's look at what we need to do. So convertible bonds, part of what our investors are buying is a normal bond and debt and an equity conversion feature. Because Branson can settle them in cash, we're going to separate our debt portion from our equity portion. So let's make another part of our spreadsheet. And we're going to call this part of our spreadsheet convertible bonds. I'm gonna make this way bigger, zoom way in, so we can maybe see all the stuff. Okay. So first we need to identify the total cash that was received. The bonds were issued at par, so there's no calculation we need to do. The cash that we received is what it was issued at, so $500,000. We need to determine the value of our debt component. We're told that similar bonds without the conversion feature would have sold for $455,000. That $455,000 represents the fair value of the debt portion. So fair value of debt portion is $455,000. Just gives us that, which is nice. We're going to determine our equity component. The equity component is the difference between what the cash received was and the fair value of the debt portion. So equity. $500,000 minus $455,000. Our equity component is $45,000. that 45,000 is going to be recorded in additional paid in capital. It should be additional paid in capital conversion features when we get to recording our journal entry. So bonds were issued for 500,000 cash, but the debt portion is only worth 455,000. So let's see. Are we recording journal entries? That what it's asking us to do. For the journal entry for Branson to record the issuance of the convertible bonds. We're recording them as we issue them here. So journal entry. The cash we're going to get is $500,000. So we're going to debit cash on, what day is this? January 1st for 500,000. We're going to debit discount on bonds payable for the amount of our equity component, 45,000. We're going to credit bonds payable for 500,000. Oh, too many zeros. Let's fix that. And we're going to credit additional paid in, oh, I'm going to spell this wrong, paid in capital conversion feature for $45,000. So cash received 50,000, debt recorded at net 455,000, equity recorded at 45,000. Everything balances, everything's properly separated into our liability and equity components. So let's go on to number 10. Number 10, we have Nolan Company. Nolan Corporation has outstanding convertible bonds with a face value of 15,000 and a current book value of 17,500. Each $1,000 bond is convertible into 25 shares of common stock, par value $5 per share. All the bonds are converted into common stock when the market value of Nolan's common stock is $50 per share. So we're going to use the book value method to prepare the journal entry for Nolan to record the conversion. So somewhere on our spreadsheet above this, we're gonna turn this into a section that says issuing convertible bonds. Then we're gonna have another section that says conversion on convertible bonds. And we're gonna start figuring out all of our information. First, we need to figure out the book value of the bonds. Well, it tells us the current book value. Well, let's go ahead and get all of our information here anyway. We have a face value of 15,000. We have a book value or a current book value of 17,500. Since the book value is higher than the face value, there must be a premium. So we're going to do premium. If for some reason this number would be negative, it would be a discount. Our premium is our current book value minus the face value. So on the books, we have bonds payable of $15,000 and premiums on bond payable of $2,500. That makes our total carrying amount $17,500. Now we need to determine how many shares are issued. So each blank bond converts to blank shares. Each 1,000 bonds converts into 25 shares. So every $1,000 bonds, that one should have the dollar sign and this one should not, converts into 25 shares. Pull that up here. So to figure out how many shares are issued, total shares issued, we want to take our $15,000 face value. Probably use some parentheses here. $15,000 face value. Divide by our each $1,000 bond, so 1,000. And then multiply that by how many shares we get for each $1,000 bond. So we have 375 shares issued. So we have our carrying amount. We have our total shares issued. Now we need to figure out the common stock at par value. Par value per share is $5. So par value per share, $5. Our common stock, we're going to take our total shares times our $5. So we have our book value, we have our total shares issued, we have our common stock. Next thing we need to figure out is additional paid in capital from bond conversions. Our additional paid in capital is the difference between our premium, or our current book value, not our premium, our current book value, and our common stock issue. So 17,500 minus our 1875. So additional paid in capital for our bond conversion is 15,625. Then we would do our journal entry. For our journal entry, we're going to debit bonds payable for this amount that we have here for our face value. With our premium, we're going to debit premium on bonds payable. If for some reason this was a discount, we would credit discount on bonds payable. If you want to make a note of that somewhere. Our common stock, we're going to credit common stock. And then we're going to credit additional paid in capital from bond conversions. So now we can change the amounts in there if we need to on a different problem, and we have all of our information. So let's start making our actual journal entry on June 1st. We're going to debit bonds payable, 15,000. debit premiums on bonds payable. I'm gonna remember how to spell premium. No, I'm not. Oh, it's just premium on bonds payable, not premiums. This is number 10 for 2,500. Credit common stock for the 1875 and credit additional paid in capital from bond conversion 15,625. Oh, I didn't go over. Let's fix that. If we added our debits and credits up, it should get $17,500. And remember, our market price there, totally irrelevant under our book value method. Okay. Last thing we're going to talk about in chapter 14, long-term notes payable. Long-term note represents a borrowing arrangement where repayment is due in more than a year. Typically, these notes require some interest payments. They're pretty straightforward, though. However, in some commercial arrangements, there may be no stated interest rate. Sometimes companies lend money to maintain good customer or supplier relations or support employees or secure future services. So the note might just say zero interest. But that doesn't mean that there's no financing cost. GAAP would focus more on economic substance, not just what's written on the note. So if there's no market interest rate, we would record the note at its present value and use the effective interest method to recognize interest expense over time. In other words, even if the note says no interest, GAAP requires us to calculate it. Let's talk about notes payable issued for cash and what happens when the interest rate isn't realistic. If our stated interest rate on a note is not fair, we cannot simply just use it. We have to use what's called an imputed interest rate. So this is an estimated market rate. It's the rate that an independent borrower and lender would negotiate for a similar loan under similar conditions. So in other words, what would the real market charge? And that's the rate we use. We impute interest in two situations: when the note has no stated interest rate, or when the stated interest rate is unrealistically low. In both cases, we're not going to rely on the number written in the contract. We're going to reflect economic substance of the transaction. So let's look at a couple of these. These are our last two, 7 and 8. And I'll walk you through how to do them. January 2nd, year 1, Jennings Company purchases machinery and equipment and borrows $200,000 on a 5-year non-interest-bearing note. The principal of $200,000 will be paid at the maturity date of December 31st, year 5. To place a fair value on the transaction, the accountant will impute an interest rate and use that rate to compute the present value of the note. Assuming that an 8% interest rate is applicable, record the journal entry for interest expense for the year ending December 31st, year 1. Okay. Back to number 7 or 8. This is 7. So Jennings is borrowing $200,000, but we won't pay any cash interest along the way. That sounds like 0% interest, but in reality, lender's still earning interest because Jennings will pay one big amount at the end. So accounting is, we're going to fix this by recording the note at our present value, and the difference is going to become a notes payable. So let's get some information. I'm going to try to do this without on our wizard tab. Okay. We have a face value of $200,000. We have a term of 5 years, a market rate of 8%. We're going to change both of those to 8. And instead of semi-annually, here we want to go to yearly because it's 5 periods. Present value, single sum. I don't know for sure that this is going to work with our table. Let's change that to 200,000. No, that doesn't work with our table. So instead we're going to go look up the amount on the table. And then I will, at some point, hopefully today, make another tab on this for you guys and I'll send it back out that has a wizard for the liabilities because that's just not working. So the present value of 1 at 8% for 5 periods. Look at our table. The present value of 1 table is table 3. 8% for 5 periods. 0.680583. So we're going to copy that. I'm going to add another sheet over here and paste it. This is our present value factor. Our face value is 200,000. So our present value equals 200,000 times 0.680583. So we have $136,116.60. We need to find the difference between our present value and our face value. That's our discount. So our face value minus present value, $63,883.40. That discount is basically future interest. We also need to figure out some year 1 interest. Our interest rate is 8%. So our year 1 interest would be our present value times our interest rate. So no cash is paid. It's not interest bearing. So instead our liability grows by reducing our discount. So our interest expense is going to increase. We're going to debit interest expense. Our note's carrying value is going to increase each year. So eventually that it reaches $200,000. And it's going to increase the carrying value that happens by shrinking the discount. So let's do our journal entry with this information. Assuming that an 8% interest rate is applicable, record the journal entry for interest expense for the year ended December 31st, year 1. December 31st, interest expense for the $10,889.33. And then discount on notes payable for that same amount. Okay. Let's go to our very last one. January 1st, year one, voter company issues $20,000 non-interest bearing 5-year notes for equipment. Neither the fair value of the note nor the equipment is determinable. Voter's incremental borrowing rate is 9%. The asset has a useful life of 7 years. So we're buying equipment, signing a non-interest bearing note for $20,000. Even though the note says no interest, there is interest economically. Voters getting the equipment now and paying later. So GAAP says to record the note and the asset at present value using the incremental borrowing rate. It's a 5-year note. Even though it has a useful life of 7 years, it's still a 5-year note. So let's find the present value of the note, same way we did over here. Our face value, instead of 200,000, is 20,000. We're going to go find our present value factor in our table. So tables, present value of 1. It's a 5-year, 9% note. So 0.649931. And again, I'll figure out how to make that, look it up for you. So our present value is 12,998.62. We've calculated our discount already, 20,000 minus 12,988. We need to change our interest rate to 9%. And we get our interest for our first year. But I think the problem doesn't really ask for interest, does it? We're required to record the issuance of the note. So it's a little different. So in our journal entry, go away. There we go. On January the 1st, we're going to debit equipment. And our present value is what we're going to debit equipment for. So debit our asset for our present value. So 12,998.62. We're going to debit discount on notes payable. For our discount amount, which is $7,001.38. And we bought a piece of equipment for our note, and the total note is $20,000, or the face value there. Notes payable. Every year we're going to do a journal entry to record interest, and we would have to update the present value at the end of every year. But for year one, this would be our debit to interest expense and credit to discount on notes payable. Okay, for Friday, start going through the chapter 14 assignment. It's not near as long. There's only 11 problems this time instead of like 20. And then we'll go over any of them you guys have questions on. If we need to go over all of them, because it's the last day before spring break, what we'll do, I'll do the same thing I did last time. Any of the ones we don't get to, I'll make you guys a walkthrough. Try to make a video walkthrough, but my video thing is still acting up. It's acting weird. It keeps recording me in slow-mo, and I don't know how to make it stop. So